What a week it's been for Opendoor. We've gone from the highs of a strong second quarter earnings report, to the sharp sting of a post-earnings sell-off, and now to a late week bounce that might just be the first sign of a turnaround. Today, the stock closed at $1.95, up about 5% on the session, capping off a volatile but fascinating few days for anyone following the story closely. While the price action has been dramatic, the underlying narrative hasn't really changed as much as some headlines might make you think. If anything, this week has reinforced two key points. First, Opendoor has shown that it can operate with real stability even in a challenging housing market. And second, the bigger picture in the economy could actually start shifting in ways that play directly into the company's hands over the coming months. Friday's session was encouraging. The stock opened with momentum, climbed early, and managed to hold onto those gains through the day. This wasn't just a quick spike followed by a fade, the move higher stuck. That matters, because it shows the buying pressure wasn't just a brief burst of activity. Some of this was bargain hunting after the huge drop earlier in the week, but there was also a genuine change in tone, and that was helped along by an important development in the macro outlook. One of the big sparks for the rally came from JP Morgan. The bank joined the growing list of institutions predicting that the Federal Reserve could cut interest rates as early as September. That's a big call, and it lines up perfectly with what we've been talking about all week. Even a small cut could lower mortgage rates, and that would breathe new life into the housing market. More buyers, more transactions, and for Opendoor, that's the environment where its model really starts to shine. The housing market is extremely sensitive to interest rates. Lower borrowing costs can unlock demand almost overnight, especially among people who have been waiting for affordability to improve. For Opendoor, that could mean quicker inventory turnover, healthier margins, and perhaps even results in the third and fourth quarter that come in better than the cautious guidance management has given. To really appreciate why today's bounce matters, it's worth looking back at how we got here. On Tuesday, Opendoor delivered results that were strong by almost any measure. They sold over 4,000 homes, brought in $1.6 billion in revenue, improved gross margins, and posted their first quarter of positive adjusted EBITDA in 3 years. Losses narrowed sharply, and the company looked disciplined and focused. But after the market closed, the stock plunged. The reason wasn't the quarter itself, but management's guidance for the rest of the year. They warned that with high interest rates persisting and the seasonal slowdown in real estate, especially in the fourth quarter, they expect volumes to dip. That cautious tone spooked a lot of traders, and in the thin, choppy after-hours market, the stock dropped as much as 24%. Midweek, though, the mood began to shift again. Eric Jackson went on Yahoo Finance and Bloomberg Radio, making it clear he still believes in Opendoor's long-term potential, while also voicing frustration with the current leadership. A shareholder letter started circulating online, calling for greater transparency and stronger execution. Retail investors began talking about the stock again, not just hyping it, but debating the numbers, the strategy, and the path forward. By Thursday, the sell-off had slowed. The stock closed only slightly lower, and in the aftermarket it held steady, even ticking up a little. That set the stage for Friday, when the JP Morgan forecast about a September rate cut gave buyers an extra reason to step in. All of this feeds into the bigger picture. Opendoor has just shown it can turn a profit, on an adjusted EBITDA basis, in one of the toughest housing markets we've seen in years. That's proof the business can operate lean, manage risk, and still grow. Now imagine adding a bit of a tailwind from the broader economy. If rates come down, Opendoor doesn't need the housing market to go back to pandemic-level activity to benefit. Even a modest pickup in sales could make a real difference. There's also the short interest factor. With shorts still active in this stock, a sustained move higher could force some covering, adding extra fuel to the rally. That's not something to rely on alone, but it's another layer of potential momentum. That said, it's worth staying grounded. This is still a stock that can move sharply in both directions, and it's in a sector that reacts quickly to shifts in macro data. If the Fed delays a rate cut, or if housing numbers weaken, the price could come under pressure again in the short term. But this week has shown how quickly sentiment can turn. We've gone from a brutal after-hours plunge on Tuesday to a strong close on Friday, and that change wasn't driven by new results from the company itself, it was driven by how the market is looking at the bigger picture. If that perception continues to tilt in Opendoor's favor, especially heading toward the September Fed meeting, a more sustained rebound becomes a real possibility. As we move into next week, there are 3 things worth keeping an eye on. First is macro data, especially the upcoming inflation reports, which could either strengthen or weaken the case for a September rate cut. Second is how the company responds to shareholder concerns, particularly those voiced by Eric Jackson and others. And third is retail sentiment, whether more investors decide to treat this as a buying opportunity or wait for clearer signs of the Fed's next move. Looking a bit further ahead, the focus will be on how Opendoor executes in the third quarter. If they can maintain profitability and position themselves for a macro tailwind, the conservative guidance from earlier this week might end up being too low. So here we are at the end of the week. Opendoor closes at $1.95, stronger than where it started the week and well above the lows we saw just a few days ago. Strong earnings, stabilizing sentiment, and the possibility of a near-term rate cut all point toward a more favorable chapter ahead. It's not without risk, but for those who believe in the long-term potential of the iBuying model and in Opendoor's ability to execute, this week could be remembered as a turning point. The key now is follow-through. If the macro environment does improve and if management can align their strategy with shareholder expectations, Opendoor could be in a great position to surprise to the upside before the year's over. For now, the takeaway is simple: this story isn't over, and after the week we've just had, it might be getting interesting again.